plan is to execute today, take the profits, and get ready for what is coming next so that I can buy the distressed properties, so that I can do what you just told me, Invitation Homes and what all these big hedge funds are doing right now. Because being ready for the next opportunity is just going to be a massive, massive win. But too many people are going all in right now because interest rates are low, which I get, but I hope most people are playing the long game if they're buying at the pricing today. So it's not even so much the pricing, it's just, can they wait? The Invitation Homes and the BlackRocks, the Blackstones, they have the capital to wait it out. If things do fall, it's just a blip in the radar. They don't care. They cash flow themselves through, and then they execute their plan at the time when it comes. But a lot of people can't execute because they can't wait. They can't make it through that season because we're coming into a stormy season. I mean, the question always comes to me is, are you able to hold this property if it loses 20, 30% of its value? Can you cash flow through that? If your rents go down 10 to 15%, is that possible? Did you run those numbers? And the answer is usually no, because they think the rents are going to keep going up. They think the pricing is going to keep going up. And then I say, well, I hope I'm wrong. But history proves that I'm not wrong. It's just what happens. But I love how you talked about that. They were playing a different game. And they're certainly playing a different game today. But the game today is not a game that any of us can play. The game today is simply, they have the cash, they have the government money, because obviously they just printed $5 trillion. A lot of it makes its way into these hedge funds.
It's more like, the way I've looked at it, is more like $20 trillion. Yes, 20 plus trillion.
They're playing a big game right now, because I'm not even factoring in the leveraging and everything else. I'm just talking about what they're printing. But they're able to go out and buy blocks. They're able to go out and buy entire freaking cities if they wanted, and they can buy at the pricing today because they're not playing the same game we are, and the money that they're playing with is Wall Street money that has already made tons of money. They're just playing with house money at this point, and government subsidized money as well.
To give you an example of that, so I actually, when I decided to go out on my own, I was kind of being positioned to be a director of acquisitions for one of these REITs. They had a $500 million line of credit from Deutsche Bank at a point.
There we go.
0.25%.
Now, let me stop you right there. Nobody understands how that's even possible, but because they don't understand Fed funds. They don't understand how you can get money that cheap. And I was just talking to another hedge fund manager out in Utah, and he was explaining this whole thing. It's just a different game. I didn't mean to cut you off, but that's so critical because people think that's impossible. It's not impossible. It happens every day.
So not only that, so they're borrowing money at 0.2%. There's another one, Lennar, had a $1 billion loan from the Bank of China for 0% interest. And so you're like, that doesn't make sense. How would anybody lend a loan at 0% interest? Well, Bank of China knows that they're going to manipulate the yuan, and they're going to make more money off of the currency exchange. And it was against San Francisco-based real estate. And so their collateral is San Francisco-based real estate and $1 billion to Lennar and the Presidio. And they're like, yeah, we'll do that at a 0% interest. And so the cost of capital is, like you said, way, way, way different when you're at 0% interest or 0.25% interest, 1% interest, when the cost of capital that you and I borrow is at 5 or 6 or 8 or 10%, so they're effectively making 10% more money on everything, and even on the leverage that they do. And then you're talking about when they securitize it. So they're then passing all the risk to a bondholder, then from a securitizing to an IPO, or now with the newest thing, the SPACs, and then creating these other vehicles. So structured finance does have some very unique levers that they can pull that the average Joe Blow that does not know. And that's where I said, like, that 3.0 version of myself was, I went back to school. I went to grad school and studied international real estate and finance. And so it was like, it really gave me that private equity and structured finance. It was like, oh, I see what they're doing, how REITs are able to, and how managing a portfolio is much different. And so back to what you're talking about right now, the markets in this frothy and speculative environment. From a residential perspective, we have massively underbuilt for the last decade plus. And if you look at this from a data standpoint, because I spent a lot of time in the data, is we were overbuilding the market up until 07, 08. And so we had a surplus of a few million homes surplus, like we built too many. But because of the fact of the ninja loans, and if you saw the movie Big Short, strippers buying 5 houses and them sitting vacant. And I was, absolutely part of that same crowd down in Phoenix. And so it was just like, it went up 20% this month. Awesome. Look how much money I made on paper. And then subsequently when it crashed, it came all down. So we had to, and every year we need at least 1 million new residential homes, products, homes, apartments, whatever. And that's from net population growth, birth rate, immigration, others. That does not factor in the institutional capital that's buying some of these homes and kind of removing them out of the they don't tear them down, but so they still are out there. But call it anywhere from 1 million to 1.2 million is rough order of magnitude that most economists can agree to, that we need 1 million new products every single year of residential units. Well, we have not built 1 million any year since 2006. And so you go to 2006 and we had to burn off the initial inventory. And as we were burning that off, because we'd only built 200,000 homes, then 300, then 400, and 500. And so that delta that we had between there, and guess what, where we hit equilibrium? In 2012. And what has the real estate done since 2012? Only gone up. So because we've still continued to underbuild, we've actually had a growing amount of demand for homes and apartments and everything else, residential units. And so we're currently sitting at about 4.5 to 5 million residential unit shortage in the United States. And that's not evenly dispersed. There's parts of Ohio and West Virginia and things like that. Those are cities that they have houses sitting empty. Really what it's looking at is where these population climbs, where is population moving to, and those are having an unbalanced supply and demand. California, the Northeast, the West Coast in general is doing a fantastic job of driving people out of those areas through crazy taxes and stupid politics and whatever else you want to call it. But Boise, Salt Lake, Phoenix, Texas are, huge beneficiaries. The Northeast is sending them down to the Carolinas and Tennessee and Florida and Texas as well. And so you have this convergence of population that is aggregating to these certain geographic regions that also is constrained by supply. Now you have layered in supply chain issues, construction costs, and you cannot even build enough units to satisfy that demand. So fundamentally, we're in an amazing place from a real estate perspective, if you're especially looking at multifamily or rentals or houses. And so you're going to see pretty sizable increases of rents and values, but that only factors in for the fundamentals. Mm-hmm. Fundamentals are not the only thing that drive markets. Where Howard Marks, he wrote a book, Mastering Market Cycles. And there's one of the things that goes into it is consumer sentiment, or how people feel is another variable or offset to that. When people feel frenzied and there's market fundamentals, you get these huge spikes in value overall. But sentiment goes away. It doesn't really matter what the fundamentals are because people are irrational. They don't look at the data. They don't make these decisions. They go, stop buying, hoard cash, go buy all the toilet paper. You've seen people do like stupid stuff. Like you're like, why are you buying all this toilet paper? This makes no sense to me. But with gas, with all these other things that are happening with war, is there going to be, World War III? That could very much change the consumer sentiment and really what exactly to your said, cause a shift in the way that, values are looked upon in the future. The Fed increased the rate are saying a little bit. I mean, you're looking at it, it's still nothing. And people are like, oh, I don't know. Inflation's high. The cost, less and less people can afford to buy a house. And so I think what that is going to do is potentially cause the music to slow down and maybe in some markets even stop. Mm-hmm. So to your point is, can your valuation, or your property or asset cover higher interest rates? Some of these bridge loans that were in IO, and it goes up. Can it sustain and do a stress test on your analysis? At what rent number or decline are you now in trouble and losing money? There's covenants in a lot of these commercial mortgages, not as many in the residential, but a lot. If you don't have certain debt coverage ratios, they'll demand you put more money in.
It's like a margin account.
Yeah, margin call. Excuse me, you need to put another $1 million into this property right now. And you're like, hey, I already put that down payment. But like, no, your rents have gone down. Your valuations have gone down. We demand more money. And so then, you need to start looking at some of those variables in this time that's more stormy, turbulent. And what about higher interest rates? What about flat rent growth? Or maybe it's not the record rent growth that you're projecting because there's population declines are moving. Are you investing in the Northeast or maybe some snowy state that people are like, I'm over this. I can remotely work anywhere. I'm going to go remotely work in Florida. I don't want to live in Minnesota anymore.